What's up guys, it's Nathan here. You might be asking yourself, should I fix my home loan in 2023? Well, a fixed rate home loan locks in your interest rate for a period of time, anywhere from 1 to 5 years. And during this fixed rate period, your repayments will stay exactly the same, regardless with what happens with the Reserve Bank and the interest rate market. In today's video, we're going to talk about the pros and cons on fixing, why you might want to fix in, the risks of fixing, and everything you need to know step by step, so keep watching. We're going to start off with why interest rates are rising. The current cash rate is 3.1%, representing an increase of 3% since May last year. We've had 8 rate rises, and this marks the highest cash rate we've seen since 2012. According to senior economists, it's projected that the cash rate could reach between 3.35% to 3.85%, meaning we could see up to another 3 rate rises of 25 basis points, which is expected to peak at the midway point of this year. And it's forecast that the rates will remain elevated until early 2024, where a lot of lenders are predicting that they will decrease. The Reserve Bank of Australia has implemented consecutive rate increases across 2022 in its quest to fight inflation across Australia. So you might be asking yourself, how does this affect my monthly repayments? Well, let's examine how consecutive cash rate hikes have increased the cost for borrowers, mainly when we look at their monthly repayment. As you can see on the screen here, let's say you have a $500,000 mortgage, and before the rate hikes happened in April of 2022, you might have been paying 1.89%. We can see, fast forward to the end of December, paying 4.5%. Your mortgage repayment has actually gone up by a staggering $700. That's over a 35% increase on the cost of the mortgage, and we've seen this across the board, and a lot of borrowers are finding that pinch to the back pocket as a result of elevated mortgage repayments. On top of that, rising costs of living. So it's a bit of a double whammy effect. And this brings us to the question that a lot of customers are asking at the moment: should I fix in my loan in 2023? Well, whether you're thinking of switching to a fixed rate, it all depends on your home loan objectives and your current financial situation. There are a number of different factors to consider. Now, if you were to fix your rate in, there are a bunch of benefits. The first is that if we see any further rate rises, as we talked about earlier, there might be another 3, these rate rises won't actually affect your home loan repayments until the fixed rate ends. It is widely predicted by a number of economists that interest rates will continue to hike this year, with it peaking and remaining at an elevated level, with potential rate cuts to start as early as 2024. Commonwealth Bank leading the charge, with their economists predicting that they see the cash rate dropping in November of this year. The other benefit is that your monthly mortgage repayments will remain the same, which gives you an ability to budget around the elevated living expenses we're seeing and not have to worry about how much more you need to meet for your mortgage as rates go up. Now let's talk about some of the risks. If the economists are wrong and the rate cuts do happen earlier as CommBank predicts, rate cuts won't affect your mortgage, meaning that you'll be locked into the elevated home loan repayments that you've locked in for anywhere from 1 to 5 years. And if rates start falling, you're not going to get any benefits until your fixed rate ends. When you fix in, you might not be able to access features such as redraw or extra repayments or offset facilities. Another risk is when you lock in your fixed rate, you have to pay large exit fees if you want to refinance, you want to sell your property, or get out of that fixed rate onto a variable rate. There can be pretty hefty penalties that apply. And the last risk is once you lock in on a fixed rate period, your home loan will roll on to a higher variable rate once the fixed rate ends, unless you refinance or make other changes. Now, to give you an idea on where fixed rates are at the moment, currently 2 years, you can get for around that low 5 percentile mark, so around 5.25%. Variable rates, interestingly, are coming in around the 4.5, 4.6, 4.7. So we can see that the 2-year fixed rate might have already factored in future rate rises. If there's another 3 and you're starting at 4.5 variable, well, it feels like it's almost baked into the fixed rate. You lock yourself in for 2 years, and then there's a potential that rates could go back down. Now, it's anyone's guess what actually happens in the marketplace, and then a lot of times we'll only know when we look back in retrospect to know if those economists were actually correct. So choosing a fixed rate based on predictions of what's happening in the future can be problematic because you might actually get it wrong. I think the key here is if you are considering fixing and you're after some stability, you're a little bit worried about mortgage repayments, and you've worked out at a 5.5 or a 5.25% fixed rate for 2 years, you'll have an ability to budget, you have some comfort in your repayments, and you're not too worried about the fluctuations if it goes up or goes down, then that might make sense for you. But if you're in a position where you've got a bit more flexibility with your cash flow and an increase in repayments doesn't break the budget and you want to sort of see how things play out, well, maybe going variable and riding it out because increases and fluctuations in repayments aren't going to make a massive dent on the family budget. And you might actually have some upside because if rates do go down sooner, like Commonwealth Bank is predicting, then you might actually come out on top. I think it is really hard to predict what's going to happen, and you've got to look at your own individual circumstances. And you can chat with a mortgage broker like ourselves, where we can walk you through all the pros and cons and help make an informed decision as to what might make sense. Another thing you can think about doing is fix in for a shorter time frame. So instead of fixing for 2, 3, 4, 5 years, you can actually fix in for 1 year. And as we've seen with some of the predictions, if rates do start to come down late this year or early in 2024, then a 12-month fixed rate term might give you the best of both worlds. Now, given you've thought about going fixed, you might be thinking, what if I stay variable? What are the pros and cons? Well, let's have a look at the benefits of going variable. Well, the first and most obvious is that you will save money if interest rates start getting cut. As we talked about earlier, the predictions are saying anywhere from 2024, maybe end of 2023. So as they start to come down, the banks will pass on those rate cuts to borrowers that are on variable rates. Another benefit is you can refinance your home loan at any stage. There's no break fees, which means if you're on a higher rate, you can actually look to move and get a lower rate with a different lender. And the last benefit is you've got far more flexibility with a variable rate where you can have offset, redraw, unlimited repayments. So you've got more flexibility, especially if you've got room in your household budget where you can save up, put more money towards a mortgage. That's where the magic happens, where you can pay the loan faster than the minimum repayments. Now, looking at the risks, the biggest and most obvious risk here of going variable is that you need to be able to adjust with increased repayments as the cash rate keeps rising. Now, the Reserve Bank makes a call on the cash rate each month, the first Tuesday of every month, and at the moment, they're trying to get inflation down. We've seen the inflationary data for the end of December. It is elevated. It's widely come in at the expected high 7%. They're expecting it to hit 8%. But once again, if inflation starts to come down, we might actually see the Reserve Bank start to slow down on some of the rate rises, which means the cash rate might actually peak at some point this year. And potentially, when we look back, there might not be as aggressive rate tightening as we saw in 2022. Once again, it's all dependent on inflation, what happens with unemployment. So many variables at play that literally anything can turn on a dime. So once again, you've kind of got to make a decision based on what's right for you at the time, based on the information we know right now, knowing that anything can literally change at any time based on new information, such as if inflation continues to rise, it gets above 8%, then we'd find that the Reserve Bank would have no choice but to go even harder on increasing interest rates, and therefore everything we've talked about is completely out the window. Now, the main reason borrowers opt for a fixed rate loan is that they're expecting that the rate hikes will continue in the near future and really want to avoid the extra costs on mortgage repayments. Like we said, the last 8 rate rises has had an impact of increasing borrowers' mortgage repayments by 38%. Now, the problem we've seen that lenders are increasing their fixed rate interest rates in anticipation of variable rates continuing to climb. So you find in that example we talked about earlier, where you can get a fixed rate for 2 years at 5.25, but your variable's still 4.5%. It feels like they've kind of calculated that there's probably another 3 rate rises to go, and they're trying to work it out so that if you fixed in, maybe you're not going to be any better off because it'll come up, then come back down. So that's something to consider when you are weighing up whether to fix or not. Now, once again, the economists could be wrong, and there might be more than 3 rate rises come. Even the Reserve Bank has said they have no preset path moving forward, which means they don't even actually know where the cash rate's going to peak. They're going to keep reviewing the data, keep looking at the inflationary stats, and make decisions based on the incoming information that they receive. Now, when is a fixed rate not a good idea? Well, the first is when interest rates start falling. You might find that you fix your loan in at the wrong time and interest rates keep coming down. We saw a lot of that as interest rates fell over the last decade where people locked in and they actually got it wrong. The second time it's not good to lock in a fixed rate is when interest rates are increasing but are very likely to peak soon. The third time when it's not a good idea to fix in your loan is if you're planning on refinancing your home in the future to do a renovation, or if you're planning to sell the property. Locking in your fixed rate can see that there are penalties if you break that fixed rate. So if you do have plans to sell, or you're planning on doing a major renovation or needing to refinance to another lender in the future, fixing in is probably going to be a bad move because you're going to have penalties to get out of that term once you're locked in. And the last reason is if you're after additional features in your home loan, such as a redraw, extra repayments, offset account. Now, some fixed rates do have these facilities, so it's important to check with your mortgage broker. A lot of lenders don't offer this. So if you are fixing in, you might want to make extra repayments past 10 grand extra per year. Well, a lot of banks don't actually let you do that. So something to be across. Did you know here at Hunter Galloway, we're mortgage brokers that deal with people across Australia. So if you're looking for a great mortgage broker, you need assistance with understanding whether to fix, buy a home, an investment, or refinance, we can help. Call us on 1300 088 065 or visit our website huntergalloway.com.au where you can fill in our contact form, and we'll see you next time.